In this presentation, we will record transactions related to a special assessment debt fund. The special assessment debt fund acting as a fiduciary type fund, recalling that there's three different groupings of types of funds. The governmental type funds, the largest grouping of funds. We have the proprietary funds, those types of funds that are similar to a for-profit type of organization, typically having something like customers related to them. Fiduciary funds, acting in trust in some ways, acting as a fiduciary in some ways, typically a holding account of some kind, acting as an agent for some other entity and holding on to some assets or providing some service related to the holding of those assets and the managing of them. This is going to be our scenario. We have a community that wants to put together a park. In order to put together the park, the city has issued bonds in order to put together the park, but the community is going to have to collect revenue in the future in order to repay for the payment of the bonds. In order to track the repayment, we have set up a special assessment debt fund. So we have a special assessment debt fund that's going to be used to track the information in order to pay back the bonds. The scenario will be that levies on the property, we have the $7 million. It's going to be paid in 10 equal installments, and we have the interest on the unpaid amount at 3%. That's going to be our scenario. The pattern of transactions then will look like this within our special assessment debt fund. First, we're going to have the assessment receivable breaking out between the current portion and the long-term portion. The current portion being the $700,000, that of course being the $7 million divided by 10. So we got the 700,000 would be let's take the 7 million minus the 700,000. That gives us the 6,300,000. That's going to be the non-current. So we're just simply taking the 7 million, breaking it out between the current 700,000 and the non-current, the 6,300,000. That being a total then of the due to specific assessment bondholders. That's going to be for the full 7 million. Recording this transaction, we're increasing the receivables. These are the amounts that we expect to get for the assessment of the special taxes. And then, of course, we're crediting the due to special assessment bondholders a liability account, because once we collect on this, that's where the money is ultimately going to go. You'll note that there's no transaction down here in what would be considered the temporary type of accounts. We're going to have to record some activity down there so we see some timing accounts of the activity that's happening over the time period. Next, we're going to say that there's going to be a collection. Of course, we're going to have a collection of the current amount and interest on the unpaid amounts. Once we have the collection, we're going to say that we're going to collect the assessment receivable of the $700,000, and we're going to collect the interest, which is going to be $210,000, which was the 3%. So if we took the 7 million times 0.03, that's going to give us our 210,000. So we're going to say cash is going to go up by the 910, and we're going to decrease the receivable of the 700,000. The difference is the interest of the 210,000. Recording this out, then we have the cash is going up. We've collected on it. The current portion then decreasing for the current portion, and then we're recording the due to special assessment for the interest, because of course, again, the interest isn't going to be staying in the special assessment debt fund. That's just basically a holding fund, a fiduciary fund. It will ultimately be going out of this fund. Next, we're now going to record the current portion versus the long-term portion. So we've jumped forward in time now. We've taken care of the current portion is now paid off. The same pattern is going to repeat itself. We have the long-term was at 6,300,000. We would now say now we got to break out the current portion of the long-term amount. That's going to be the same 700,000, 10 equal installments of the 7 million. So we're simply going to break that out by debiting the assessment receivable current and crediting the assessment receivable non-current. So we're going to take it out of the assessment receivable non-current, bringing it down. We're going to put it into the assessment receivable current, bringing it back up. Next, we're going to take the money that we're going to have. We paid it out. So we have the 910. We're going to pay out the amount that's going to be due to the special assessment bondholders, 210. We're going to pay that out for the interest and the principal that we collected. So the 910 cash is now going to be leaving. And we are then going to say that the debit is going to be 700,000 of the due to special assessment for the principal. And then we have due to special assessment related to the interest, that being the 210,000. Recording this then, cash decreasing down to zero. we've got the due to special assessment for the principal decreasing by the $700,000 to get to $6,300,000, and then the interest decreasing down to 0. You can see, once again, no activity down here on the temporary type of activity in terms of the income statement or similar to income statement type of accounts down below. We are, of course, required to record temporary activity down below, so we do need to record transactions down here. The transaction we're simply going to record is to record the activity, and that will be deductions, payment for principals to bondholders, deductions, payments of interest. So we're just basically going to record that out. The credit then, or the income similar to the income statement type account or the revenue type of account, is going to be additions, principals, and interest collections. So this is going to be the temporary account, the temporary activity. So if we record this out in the temporary activity, we're going to increase the additions, the temporary similar to the revenue type of account, and then the deductions, and that's going to be the activity that we're going to have. That's going to be the temporary activity similar to basically the income statement type of activity we are required to report for the time period.